Derivatives are financial instruments whose value is derived from the value of an underlying asset, index, or benchmark. They are used for various purposes, including hedging, speculation, and arbitrage. It is an overview of key aspects of derivatives. 1. Types of derivatives. Forwards. Customized contracts to buy or sell an asset at a specific price on a future date. They are traded over the counter, OTC, and can be tailored to the needs of the parties involved. Futures. Standardized contracts to buy or sell an asset at a predetermined price on a specified future date. Futures are traded on exchanges, which helps mitigate counterparty risk. Options. Contracts that give the buyer the right, but not the obligation, to buy, call, or sell, put, an underlying asset at a specified price before a set expiration date. Swaps. Agreements between two parties to exchange cash flows or financial instruments over time. Common types include interest rate swaps and currency swaps. 2. Uses of derivatives. Hedging. Protecting against price fluctuations in underlying assets. For example, a farmer might use futures to lock in prices for crops. Speculation. Taking on risk in hopes of profiting from price movements. Traders might use options or futures to bet on the direction of asset prices. Arbitraje. Exploiting price differences between markets to generate profit without risk. For example, buying an asset in one market and simultaneously selling it in another at a higher price. 3. Risk management. Derivatives can be powerful tools for managing financial risk, allowing investors to hedge against adverse movements in asset prices or interest rates. 4. Leverage. Many derivatives allow for significant leverage, meaning small price movements in the underlying asset can lead to large changes in the value of the derivative. While this can amplify gains, it can also magnify losses. 5. Market participants. Derivatives are used by a wide range of participants, including individual traders, institutional investors, corporations, and financial institutions. 6. Regulation. The derivatives market is subject to regulation to promote transparency and reduce systemic risk, especially following the 2008 financial crisis. Regulations may vary by each country and type of derivative. 7. Pricing. Derivative pricing can be complex and is influenced by various factors, including the price of the underlying asset, time until expiration, volatility, and interest rates. 8. Liquidity. The liquidity of derivatives can vary. Exchange-traded derivatives, like futures, tend to be more liquid than OTC derivatives, which may have less transparency and higher counterparty risk. 9. Tax considerations. The tax treatment of derivatives can vary significantly based on the type of derivative and the jurisdiction, affecting capital gains and income reporting. Derivatives can be useful for sophisticated investors and institutions looking to manage risk or enhance returns, but they require a strong understanding